welcome to Street Check, the best podcast in the history of Cabot Wealth Network, which has been in business since 1970, delivering insights, research, and investment ideas for more than 50 years. I'm Chris Preston, Chief Analyst of Cabot Stock of the Week and Editor-in-Chief here.
And I'm Brad Simmerman, Web Editor and Chief Analyst of the Cabot Wealth Daily. Today, we are going to do a little bit of an instant reaction to Powell's speech in Jackson Hole. We're going to talk Nvidia earnings, what that tells us going forward. And then we're going to talk about the worst go public offering in history, at least as far as I'm aware, before we ultimately bring on Nancy Zambell from Cabot Money Club to talk about investor sentiment, her take on the markets, and real estate in general. She is a realtor, so her insights should be pretty valuable for any of you out there that are interested in either that sector or are looking to buy a home. But before that, Chris, it's your turn for Defend the Take. This week, the S&P will be up double digits from here? Question mark? You have 90
not this
seconds.
week. Yes. Okay, I'll go. So yeah, just to elaborate, I think the S&P will be up double digits through the rest of the year from here. But I also think that we may not have hit the low yet. We may not have bottomed yet. It's about even since Jay Powell talked a couple hours ago. We'll get into that. So here's my rationale. We are now flirting with the August 18th bottom. We may dip below it some. The average gain in years when the first 7 months were up double digits, like this year. The average gain dating back to 1950 in the S&P for the remaining 5 months in those years is 6%. And we're down, S&P is down roughly almost 5% in August alone. So we're already in a hole there. Between the Fed possibly pausing, again, we'll get into that. Inflation improving so far, no recession in sight. There's lots of reasons to be optimistic about the rest of the year. And, another thing is this: when the S&P is up 15%, the average pullback, as I think I mentioned last week, following that is 8.2%. We're now roughly at 5%. So this is normal. This is a normal pullback. And they usually don't last longer than a month or two. Maybe it'll last another month. We've been almost a full month, but I think even if it does pull back more, the S&P will be up double digits through the rest of the year.
All right, and time.
The post there? Yeah. Good.
Yeah, well, close enough. Yeah, so I should clarify, when I said this week, I meant this week on the podcast. This will be your take. So yes. I don't want anybody thinking I'm saying S&P's up double digits in a week. No, I'm not.
It will not be up double digits in the next 4 hours. No.
So this is good timing for us. Powell just finished speaking at Jackson Hole. It was a brief speech. What were your takeaways from it? I have some notes that I had pitched to you, but I'm curious what your first impression was with Powell.
As expected. He said not ruling out any further rate hikes. I don't think anyone was really ruling out further rate hikes going in. Another one more rate hike the rest of the year would not really surprise people, would not really throw markets off too much. More than one would. He didn't get into numbers, and he didn't get into next year possibly rate cuts, which I think Tyler London has said the market is priced in, or kind of a forecast up to 4 rate hikes. That seems like a lot now, but that's a long time.
4 rate cuts.
Rate cuts, excuse me. Yes. Yeah, rate cuts next year. I would doubt that would start until probably the second half of the year, at least till after the first quarter. It really just depends on how things go. But I don't think he said anything today that was out of left field or really changed the calculus. And that's investors have reacted accordingly. Market's sort of about even since he talked this morning.
Yeah, two things, or a couple of things that I had keyed in on. He hit the 2% number really hard. Yeah. And he did it more than once. There were at least 2 times where he specifically referenced 2% inflation. We have speculated if maybe they'd be satisfied with like a 2.5% ongoing inflation rate, and it does not sound like that's the case.
No, also 3.2 right now as of now.
Yeah, and he also pointed to the He pointed to the unexpectedly strong consumer, which we have been talking about repeatedly.
Yeah.
It did sound like that caught them off guard a little bit. Their projections, maybe internally, didn't seem to line up with what they're seeing trickle through the economy right now.
Hmm.
The one thing that I had, my sort of overall takeaway from it was it felt like a sort of a stay down moment, right? Like if you imagine two boxers or fighters or whatever, one gets knocked to the canvas and the other guy says, "Hey, stay down," or we're gonna unleash one more.
Yeah.
That sounded like the Fed stance on inflation. They feel
Yeah.
like they've won. They know that there's a chance it gets up off its knees, but they're sort of ready to hammer it with more rate hikes if necessary. So if we get maybe a little bit of softness in the labor market specifically, that was another thing that he hammered repeatedly, was the strength in the labor markets. If we get some softness in labor, if we get maybe some softness in rents, if we see rents start coming down, which is going to drop the core inflation numbers that they're so attentive to, I think that sort of paves the way for the Fed to potentially cut rates early next year. For the balance of the year, the market's currently pricing in a 50% chance of a rate hike at the
Yeah.
December meeting or by the December meeting. Bank of America came out and said that they're looking for one more rate hike. Goldman Sachs, on the other hand, said no more rate hikes. So there's definitely a tug of war going on right now, but I'm still seeing what we've been saying all year, or what I've been saying all year, which is the Fed is being very responsive to what they're seeing in the economy, and they mean what they say when they say higher for longer. So if we drag out if we get one more rate hike and it drags out into the early part of next year, like you said, post Q1, I could see a path for rate cuts then. But my pitch to you for an episode title, which you liked but got shot down, was Jackson Hold. They're in a holding pattern. They're going to keep saying that they're paying attention to the evidence, that it's higher for longer, and they need to see more softness in the economy. So I'm not going to be surprised one way or another. But it did feel like a little bit of a hawkish victory lap.
Yeah. I like that you corrected yourself with, you said we've and then said I've been saying about the Fed, because clearly I'm no authority on the Fed. I twice have said that they were not hike rates anymore, and they did.
So one thing that I will point people to, you had mentioned that Tyler was pointing that the Fed expects to cut rates next year. You can see that information on the FOMC website. It's under their supplemental materials. It comes out quarterly. The last one was in June, and the next one will be in September. But they show what their projections are for the next couple of years for things like unemployment rate, interest rates, etc. So you can see what the Fed hopes these numbers will come in at. And if the numbers are coming in and matching expectations, you right now can take the Fed at face value that they're going to do what they're saying they're doing. So if you want to be a little bit of a Fed mind reader, look at that supplemental information that comes out quarterly, and that'll lay out what the Fed is looking to do for interest rates over the next couple of years. So that's just a little.
Yeah. Okay, let's move on to the other big event for this week. Nvidia's reported earnings on Wednesday. They're quite good. Wednesday after hours. But the market response to it, including among AI, other AI stocks, AI related stocks, was not good on Thursday, even though there was on Wednesday, stocks were up big prior to Nvidia's earnings. I wonder if, it caught wind that they were good, and then coughed them all back up, just as the market's been doing lately. How much do we read into, I guess it's twofold. Nvidia's earnings, the fact that they were this good, I guess we've talked about how there was a romance phase with AI back in the spring or early summer. And then there's sort of the, I guess, comeuppance, and now we're settled into a reality phase of we got to see the numbers. Well, the numbers were good, at least for Nvidia. So how much does this mean for the AI sort of boom? And then what does the market response sort of sell-off mean for the markets, how the market views AI at large right now?
So I think that I'm going to have a mea culpa on this one. I was probably premature in calling an end to the romance phase with AI as being like a Q2 thing. Obviously, big business is still shoveling money into the AI fire, right? Like Nvidia's earnings show that the big spend is there. So the market is going to allow this trend to continue for probably longer than I would have expected, or the trend is more meaningful than maybe I gave it credit for personally. As far as Nvidia's response to earnings, they traded up as much as 10% in the
Yeah,
after hours, maybe
Nvidia responded quite well. Yeah,
yeah,
sorry.
maybe as much as 13% before giving it all back. They're up 2% in the last week. That includes their response to earnings. The my takeaway is one of valuation. Right now, Nvidia is trading at 113 times trailing 12 months earnings. That's down from like 250 times 12 months earnings. But even if you annualize the most recent quarter, Nvidia is still trading at 50 times annualized most recent quarter earnings. That 50 level is where Nvidia has peaked in prior sort of cycle highs. So before the great financial crisis, we saw it leading up to that 2018 sell off. It's Nvidia right now. I've seen calls for price targets at 600. I think I saw one for a price target of 1100 come out, which is, maybe an achievable valuation, but it's going to take a while to get there. You're going to need a year of growth like this to justify those valuations, not just one or two more quarters. So if you're maybe like a long-term bull and you're just sticking in your back pocket, yeah, jump on Nvidia and hold it forever. They're obviously making headway with the AI craze and they're very profitable, but you're gonna have to wait a while for the numbers in their earnings to justify the levels that it's trading at right now.
Yeah, and I think the fervor for AI is still out there. I just think the market is, as our colleague Mike Santolo likes to say, is sick right now, and any gains are immediately given right back. And that's just been limited to August so far, and hopefully, as I said, hopefully it won't be much longer than another few months, another few weeks, maybe a month. But yeah, I think obviously AI is still the major trend in the market, and I think Nvidia's earnings show why. I think obviously not every AI related company is Nvidia, but it's why all these companies want to get into AI and why so many of them mention them on their earnings calls. Like, hey, we have this AI, we have this 0.1% of our revenues are AI related. Let's talk about that.
And Nvidia has a solid moat. They've been working on GPU architecture and integration and software and AI for a decade. Their customers trust them. They're fully integrated. So it's going to be really hard for a competitor to Nvidia to come up and make the same kind of AI play, just because Nvidia is so integrated into those spaces. So I do think that a lot of AI value will end up accruing to the big boys, to Google, Apple, Microsoft, Amazon, Nvidia. I think that it's going to be tougher for a competitor without something that's a really novel solution. So right. Unless you've got like a better mousetrap, it's going to be really tough to break in.
Yeah. Okay, let's move on to number 3 in our big 3. As you mentioned, the worst IPO in history, BETR, this Better Home and Finance, went public yesterday. It was down 93% in day one. Why was it so bad? What does it say about this? Is a mortgage lender. Mortgage rates are at 7%, so the timing is not great. Mortgage rates are at 2-decade highs. There's a lot of history on this one. They combine it with a SPAC, Aurora, they're supposed to go to public in 2021, backed by SoftBank, $550 million, announced in 2021, delayed by regulatory issues, layoffs at Better Home and Finance. They laid off 900 employees via Zoom, which is the platform we're on now, in December 2021. And obviously back then that would have been a great time to go public when mortgage rates were at lows. You get less than 3%. And after huge growth in 2020, 2021 in the housing market, well, times are different now, as we mentioned, the Fed. Why did they go public now?
All right, so this is a good sort of illustrative case of how wrong a SPAC that goes wrong can go. So like you said, they were initially backed by SoftBank. The initial fundraise round for the SPAC was $220 million. They had the layoffs, which I had forgot. I didn't even realize that was the same company. I was like, I remember the black eye. I don't remember who had it though. Yeah. So they had the delayed SPAC offering because of regulatory issues. One feature that a lot of SPACs had was, you have as an investor the ability to withdraw if the SPAC doesn't close a deal by a certain time. What happened with BETR at the time? It was Aurora Acquisition Co. 93% of the initial investors withdrew their funds when the deal failed to materialize. So you ended up with 97% of the shares being held by management and sort of SPAC participants, right? Like institutional level. What ended up happening is when they did that $500 million dilutive bond offering, it massively diluted the shareholders. They went from 9 million shares in the acquisition company to 800 million shares in the publicly traded company. And the acquisition company shares essentially became a closely held corporation, right? It's almost entirely owned by insiders. They were trading as high as $50 a share at the beginning of August on very thin volume. They traded down to 1744 or so the day before the acquisition took effect. And then, like you said, they lost 93% of that would have valued the company at 16 billion. They lost 93% of value when they started trading the next day.
Does that make BETR a buy right now? It's up 9% today.
No, they lost 300 million in the year that they were supposed to go public and had projected that they would return 150 million. Last year, they lost 800 million on 300 million in revenue in a tough market for mortgage originators. I would say BETR is not a buy. I wouldn't. That's not even one that I would like throw.
Worst IPO in history is probably never a buy. At least not the day after, or even months after.
And I should disclose there could be a worse IPO that I'm not aware of.
It's fun just to say worst in history about anything, best or worst.
And it's a take public. It's not an IPO. It doesn't have the full financial disclosures, which is why SPACs got popular, because these venture capitalists in Silicon Valley were like, oh, we have all these massively valued investments that we can't unload easily because these are companies that aren't going to be making money for 5 years or 10 years. So we can't really show the financial results that we need to for an IPO. Oh, let's do this SPAC, which is subject to less regulatory scrutiny. You don't have to be able to show that your balance sheets actually work and that you're going to drive a profit. It can be purely speculative bubble, which we had in 2021. I mean, Bitcoin going nuts, crypto going nuts, NFTs, SPACs, like growth stocks, everything was going nuts. It was a speculative bubble. Yeah, GameStop, perfect example. So I don't know. I guess the takeaway is be mindful of hype-driven anything.
Yeah, and maybe don't invest in a mortgage lender when mortgage rates are at higher
20-year highs.
Yeah, 20+ year highs. Okay, let's move on to today's guest. Brad, you mentioned at the top, Nancy Zambell, who is chief analyst of our Cabot Money Club and Stock of the Month publication. She's been with Cabot for years. She's coming to us from, there you are. There you were.
Right. There you are. For years, it makes me sound like I'm 100 years old.
Oh, I've been with Cabot 90. For years too. Nancy, thanks for joining us.
You're welcome.
Coming to us from Tennessee, I believe, unless you're on vacation. So, Nancy, a lot of what you follow as chief analyst of Money Club, is investor sentiment.
Right.
I'm interested to hear how that has flipped in the last month. If you have any readings on that, I mean, I'm sure things were quite bullish a month ago. I remember you saying that, I think, on a company meeting. What does it look like now?
It's still bullish, but it's less bullish.
Right.
So we've dropped significantly, and the bears haven't increased that much, but the call for correction has increased significantly. So a lot more people, individual investors as well as professional investors, are now saying, okay, looks like we might have a correction, which, that makes sense. I mean, we've been flipping around that 34,000, 35,000 mark on the Dow for months and months and months. I don't even know, it might even be a year. And there's a lot of overpriced stuff out there.
Yeah, and I think so. The pros, I think, tend to be more, or have been more bullish. I think than haven't they recently? They've remained bullish. Yeah.
When the regular individual investor becomes bullish, that's when we usually sell.
Right. Yeah.
A little late, right?
Yeah, exactly. Yeah, I know Mike Santola uses this. When sentiment's down is when he likes to buy. Sounds like down some, but maybe not to where it was.
That's what Buffett always said: when there's blood in the streets, that's when you start buying. I think that quote was actually attributed to an investor back in the 1800s named Rothschild, but Buffett just sort of adopted it for himself.
Right. Yeah, exactly.
I always like the addendum: when there's blood in the street, buy, even if it's your own. That one always stuck out to me.
Well, that's true, but the problem is, if it's your own, you usually don't have any funds.
Yeah.
It's just like in the housing market, when things are really great, who's got money to buy a house, right?
Right. Yeah. And you mentioned the housing market. I think you're a realtor in addition to analyst.
Yeah,
right?
I own my own real estate company.
Right. So what are you seeing? So one of the things Powell said today, I wrote this down: housing sector is showing signs of picking back up. Is that something you're seeing just anecdotally where you are?
It's funny that he says that, because he's just late to the ball game on the housing market, because it picked up a lot, went down after COVID just a little bit, then it went crazy after COVID, then it sort of went down again, but prices are still rising. I mean, nationally, they rose 0.7% last month. And in the South, we had double-digit price increases. So it's kind of interesting. The thing I've seen it's going to slow the market is the lack of inventory. Nationally, I think there were 43 days on market as average. Here in my area in Tennessee, 8 days. So we're still selling almost everything that gets put on. I mean, we put on a couple of houses yesterday, and I think they'll be gone by Monday, which is great, for the sellers. For the buyers, it's tough because you're dealing with rising prices. And there were 60% of the metro markets that the NAR, the National Association of Realtors, just surveyed. 128 of those 221 markets showed price increases, significant, double digit in many, many areas, especially in the South. But two things that are happening: the prices are still rising, though I'm seeing them not rising as fast as what they did last year. Right. And the builders have had their hold on the market in the last year because there's been such a lack of inventory in the pre-owned homes. Sound like a used car dealer now, don't I?
Yeah.
Pre-owned home market. So the lack of inventory, so the buyers had nowhere to turn except to build a new home. So the builders have been just going gangbusters for the past year, but that is starting to slow down now. And this is a totally not specific official statistic whatsoever, but when I drive to my office up in Cumberland County, I go often the back way, and there's one street called Westchester, and that's right before you get to my office. And I always count the number of new homes that are going up. So last year, this time, there were 11 to 15 just on that street. Yesterday, there were 3.
Okay.
And it's being played out in the building statistics too, that the NAR expects that the home builders will slow down actually by about 25% next year or this year, and maybe up 24% toward the end of 24.
Are they chalking that up to labor shortages? What's
Well,
the
that's a problem. No one can get, we're in a small town, both of my offices. So you don't have a lot of the big national builders here with their own crews. So most of these guys are all after the same subcontractors, and they're few and far between. So yeah, that's slowing things down. And just the fact that I think with interest rates at over 8% now for a 30-year mortgage, that the buyers are like, yeah, maybe I'll just wait till next year and see what happens if the Fed starts reducing rates. Of course, mortgage rates won't come down as quickly as they came up. They never do.
yeah.
But yeah, I think that's what's hurting the builders down. And there still are some supply shortages, the builders are telling me.
Right. So mortgage rates, even the way they've been escalating they haven't totally, cut off the market the way that I guess the Fed intends, at least from what you've seen.
No, I mean, because there's still a lot of people with cash. I mean, thanks to the stock market,
Right.
And we did a deal yesterday for a guy he's buying a $450,000 house and he's selling a $350,000 house, and he needed a bridge loan, but he's got $250 in cash. So his loan, he didn't really care about the interest rate because it's going to be for a short term. And so what if it's 8%?
Yeah. Wow.
Yeah, I'm glad you asked that. That was something that, I've seen anecdotally out here in Arizona, especially. We get a lot of transplants from California.
Yeah.
So what ends up happening is they sell a 1,900 square foot home in LA for $1.9 million. And then you can buy pretty much any house in Arizona in cash when you do that. You come and you buy a 300,000 or 3,000 square foot home for $600,000, for instance. How much? I'm curious on the sort of housing supply side. Like, I know that we don't really have rates haven't come up this quickly in a long time, 50 years or whatever. How much are we in a gilded cage of low interest rates right now? If you're a homeowner and you've got a place that you're relatively happy with, but you're paying 3.5%, what's the threshold where you're seeing people say, even at those rates, we need to upsize, we need to move up, or we need to relocate? What are the thresholds that are driving people to make those decisions?
Yeah, it's very few people that are actually doing that. I mean, if you need to relocate, I mean, I don't think people relocate company-wise, corporate-wise, like they used to. When I first came into the workforce, IBM was a huge, huge name, which it still is. And IBM had the habit of moving their folks every year. My neighbor used to tell me, as soon as I get the new drapes in, it's time to move again. And that's what they did. But people don't do that anymore for a number of reasons. So if you relocate, it's kind of like what I did in my magazine last month, talking about the remote workforce, is because you can work remotely and you choose. But most of those people are choosing to go to a cheaper place to live. Because we had some folks that came in from California and they had a decent house, I guess, but they bought a beautiful 3,600 square foot home on the lake here for $950,000, and they thought they were in heaven.
Yeah.
They chose to, because they can both work remotely. So why not want to live on a lake where the temperature is moderate pretty much year round? So I think that's it. Most of the existing homeowners who have a 2%, 3% mortgage, they ain't moving unless they've got a real good reason if they have to get a mortgage on the other end, because it just doesn't make any sense. Even though people go, yeah, I know, we've lived through rate cycles and we know they're going to go back down again eventually and you can refinance. But, for a lot of people, with prices going up from a 250 house from 2 years ago, which is now 350, and an 8% mortgage rate, yeah, why would you want to move?
Yeah.
Putting your investment analyst cap back on, would you be a buyer of housing related stocks right now? And I'm asking this as a guy who just recommended Zillow to subscribers in Stock of the Week this week, based on what Tyler's recommendation too, but on the premise that rates coming down next year will be good for a housing market. But how are you sort of treating housing related stocks
the housing stocks seem to lag what the real housing market is doing.
Right.
And we had some great rises like Bruce Kaiser, Cabot. It's not, what is it called now? It's not Cabot.
Value investor.
Cabot Value Investor.
Cabot Value Investor. Thank you. He recommended MH Homes maybe a year ago, and I picked that up in my Cabot stock of the month, and we did really great on the sold out of it recently. It took a while for it to come back. So I probably would not be a buyer just yet.
Okay.
the housing stocks. Zillow is sort of a horse of a different color.
Right. Yeah.
Because it's not really a housing stock, it's housing related. Some of the building suppliers, I mean, most of those have already gone way up, the Home Depots and the Lowe's and all those kind of places. So no, I'm still favoring financial stocks, and I'm just waiting and praying with bated breath that one day they're actually going to bounce back again.
Yeah. And yeah, getting into that. So you, as we mentioned, you run Cabot Money Club and Cabot Stock of the Week, or Stock of the Month, excuse me. Explain what those are and how it works, and in terms of analyst contributions and the monthly issues.
Well, the Cabot Stock of the Month is similar to your Cabot Stock of the Week, only I think that you have a more aggressive portfolio than what I do. Mine is probably more of a long-term portfolio.
Yeah.
And so I try to look at all what the analysts at Cabot are recommending that particular month when I'm going out, and looking at those stocks in view of what the industry and the overall market is doing, and what I might think may be good portfolio stock for us for, I'd say, for the next 9 to 18 months is really what my time frame is. And I'm not super aggressive in it. I mean, I do have one of Michael Brush's marijuana stocks in there, but it's just because I wanted to give him some exposure, and eventually that market should come back again. But I'm not expecting anything out of it anytime soon.
Speaking of buying your own blood, as Brad mentioned earlier.
Exactly. So, but ours is fairly conservative portfolio, although I do label every one of the stocks as aggressive, moderate, or conservative, so that the investors do know that this may or may not work for their portfolio. So and we update those stocks every month and create a portfolio that the investors have, the subscribers have access to. And then we also added ETFs to that portfolio. I don't know if it's been not quite a year ago, I don't think. So we're trying to run some different ETF portfolios, and once in a while I'll put here's a sample of what you could use our portfolio for, and whether what your age group is, what your risk profile is, etc. And then those we update as needed. That portfolio moves around a little bit more than the Cabot Stock of the Month, the actual stocks do.
And I should point out the Stock of the Month does a great job of explaining the rationale behind the picks, because there's a sort of a deep dive interview format that goes along with it, where the sort of selecting analyst, and you do it a little bit in Stock of the Week, Chris, but we're talking 3-page interviews, things like that, that are a lot more
thorough for sure with the analysts. Yeah.
Well, I have a little bit more time to work with it. So I like to do that. And then in addition to, having the feature article with the recommendation, the interview with the analyst, the portfolio updates, I also have another side article in there explaining a little bit more about the company in depth, maybe somewhere that maybe the analyst didn't take us to, just because they didn't have enough time or room in their publication, and also a little bit more industry in-depth reporting, just so that people can see what's going on. Because a lot of subscribers and investors won't necessarily own all of the stocks in any of our portfolios, but they may own, like I just recommended, Noble Corporation, which is an oil driller, and they may not own Noble, and maybe they don't want to buy an oil company right now, but they might own 2 or 3 other companies. So the industry update helps them with their existing portfolio too, to decide, what is this industry, what's the outlook for it right now.
And it's good educational content too for investors that really want to take control of their portfolio. Maybe somebody that's been sitting, let's say new retiree, you've been sitting in a 401k for the last 30 years, and you sort of want to be responsible for your own investment decisions. That's the kind of educational content that somebody like that would benefit from.
Yeah, it's kind of a deep dive. And it's funny, when I started in the newsletter business, which was somewhere around 93 or 94, I think, my mother, who never bought a stock in her life, used to avidly read the newsletters. Because back then I was doing 1 stock a month, and it was like 12 pages on this company and everything there was to know about the company. And I'd say, Mom, are you reading that? She's like, yes. And I said, why? She goes, I just love the story.
I'm glad someone's mother is reading their stuff. Once I get my mother on board, then I'll know the market's probably at a top.
Then you got to sell everything. So that's the Cabot Stock of the Month. And then the other one that I do is the magazine, Cabot Money Club magazine. And that's basically a financial magazine that's geared toward, maybe newbie financial people, and maybe people who just needs a different place, a different way of looking at things. I mean, in that particular feature, I mean, we talk about just anything to do with finances, and we also throw in some investment stuff. I mean, some of my recent articles, I just did the one this month, which was just published this morning, on basically aging and what we have to look forward to in terms of care, you know, individual living, or whether you're in a nursing home, assisted living, memory care. And I wanted to deep dive on that because I have a lot of friends that are getting to that age. I mean, none of them are in assisted living yet, but a lot of them are talking about this co-housing trend, which I call communes. And it's not like commune, like Manson communes, but it's where people get together. They have their own home, and then they have like a central gathering area. And that is becoming very popular. And of course, this is not for people who are ill, who have chronic illnesses. You still got to be lively and outgoing and you know, and able to take care of yourself. But we baby boomers are very social people for the most part, and we would like to keep that up, you know, in our older years. So it's kind of interesting to talk about that. The one thing that was concerning in all of that research was how to pay for that care, because it is just ungodly expensive. And if you don't have long-term care annuity or long-term care insurance or VA benefits, man, you are in serious trouble, or a lot of savings, because you're going to have to depend on Medicaid. And you know, the facilities that take Medicaid do not have the best reputations, and I didn't even go there in the article. But it's a big concern for people, which is why at the end of the article I recommended a few investments, some stocks and some ETFs that you know, go along with this whole care issue. But some of the other things we talked about, I talked about the remote work that I did last month in the magazine. And I was shocked, really, very surprised to find that I think there were 9 states that will actually pay you to come and live there and work.
Vermont has been one of them. $10,000.
Yes.
Yeah, they might. I think they're discontinuing it finally, but they have been. Yeah, 10,000.
Yeah, in Vermont, at least to me, that's a state that sounds great. But so many, and you get a lot of snow up there, but a lot of them are very snowbound states, which I'm not going back to. I'm sorry.
Yeah. I think that's why they're offering that. Yeah, you're right.
Yeah. And a couple months ago, I did a bucket list traveling on a budget, and Brad writes our headlines for that, and he does such a great job with that. And I just love that headline because, you know, my bucket list is like 100 pages long, and I'm not going to live quite long enough to get to all of it. But there are some great bargains out there now.
Yeah. It's really a great read. Like you said, it's deep dives into these longer issues, and you know, that's so the nature of the publication. Monthly, you have time to really explore, you know, certain issues, like you said, travel and housing and whatnot. So I highly recommend it if people are interested. It is on the CabotWealth.com website under the premium memberships tab, Cabot Money Club. So people interested in subscribing, again, I highly recommend it. Can go to that. Brad, do you have anything for Nancy before we let her go?
I did want to tie the most recent article back in with something that we were talking about. Nancy, you said, you know, the Medicaid, the places where you can live on Medicaid don't have the best reputations. You know, we talked about people moving. It's very preference driven. So when you're reading something like when you're reading about the rising cost of senior care, if you're my age, if you're 40, right, you may think to yourself, oh, I'm not impacted by that. Well, no, the reality of it is you are, because you've got aging parents, friends. The medical stuff is a lot like that famous quote about going bankrupt. How did it happen? It was sudden. What was it? Over a long time and then all at once, or over a long time but suddenly. That's what people need to be sort of guarding against. And that's why you invest when you're 30 and 40 and 50, so that when that thing that's been coming for a long time happens all at once, you have the financial flexibility to be able to make those preference decisions, like where to retire, where to spend the last of your working years, where to put your aging parents up in a retirement community, right? Like you can't say that you're going to send your mom to the worst retirement home in the city because that's all you can afford. You do everything you can to make sure that that's not what happens. So I do want people that maybe hear this and say, oh, well, I don't need to worry about retirement. I'm not buying a house. Yeah, these are things that will come into play for you over the duration of your life. So having a little bit of information and being able to make plans and make decisions at an earlier point in time gives you more flexibility when it's rubber meets the road and you have to make those decisions. So
no, you're absolutely right. I mean, and that goes for just investing in general. I mean, you're 20 years old, you want to go to the nightclubs and go on vacations and do all this crazy stuff and don't want to put your money away. But, you know, the compounding of interest makes a big difference. And with long-term care, I'll just give you an example. If you buy long-term care insurance, which most people recommend that you probably start thinking about it in your 50s, you might have a premium of a couple $100 a month, which, yeah, it may sound like a lot of money to a young person, but in reality, it's not, because the average long-term care nursing home ticket is $7,000 a month. So if you pay the $200 a month now, and then, or if you wait till you're 65 to start getting long-term care, now you're going to be at $1,000 a month. Now that's significant. And especially if people are want to retire and they want to go on Social Security, if that's all they have, they can't afford that. You know, so you've got to think about it now. And there are a lot of decisions that come with it that need to be done before your parents become 75 or 80, and they need to participate in the decision. And because I've seen it happen too many times with friends who all of a sudden, oh my God, there's no one to take care of my parents. Now, what am I going to do? I work full time. I can't do this, you know, or we don't have the money. Where are we going to get the money? And then alternatively, I have had 3 friends recently whose parents have died, but they all had long-term care insurance, and it was such a relief for the family because it was all laid out and they could choose where they wanted to go. And the difference between choosing a Medicaid facility that, you know, maybe Medicaid's paying them $2,000 a month for, versus a nice facility that's clean and has good meals and good health care is a big, big difference. And like you said, you don't want to put your parents in one of those other places.
Right. Nancy,
am I depressing you? I'm depressing you.
Yeah, no, let's end on that high note. Yeah. Nancy, thank you for joining us. I'm glad we finally were able to have you on. It's long overdue. Again, that's Cabot Money Club under Premium Memberships tab on the CabotWealth.com website. And that does it for this week's edition of Street Check. If you like what you've listened to, hit the like button, subscribe, give us a 5-star rating. And also, if you have any questions from this episode, you can email us at streetcheck@cabotwealth.com. Thanks again for joining us, and we'll see you next week.
Thanks, Nancy.
You're welcome. Thank you.